I've always wondered, what's the devil look like?
Well, of course, there are all manner of lesser imps and demons, Pete, but the great Satan himself is red and scaly with a bifurcated tail, and he carries a hay fork.
Oh, no. No, sir. He's white. As white as you folks. With empty eyes and a big hollow voice. He love to travel around with a mean old howl. That's right.
Yes, and Boeing is uniquely trying to meet demand. There, they have to put up more factories. They have to hire more people. Yes, they've done a fabulous job of returning capital, but they have gigantic free cash flow. They can afford to continue to buy back stock. They can afford to continue to raise the dividend, and they can afford to be able to put more plants up. Remember, there's a backlog of an insurmountable number of planes that they have to make, and that's because there's a long-term story of the middle classification, particularly of the Chinese, who want to take trips. They need more airplanes, but also for freight. Don't forget, freight is the fastest growing end because of e-commerce.
You had the
rose by more than 2%, helping to power the Dow higher. The stock was up after the company announced a 20% hike to its quarterly dividend and an $18 billion share repurchase plan. Boeing will now pay out $1.71 a share, up from $1.42 a share. Meanwhile,
fundamental point on this business is no longer a high cycle business. This is a long-term sustained growth business.
Which I guess deserves a higher multiple.
Yeah, that's what, you know, I'm thinking.
What was your reaction, though, watching your stock price move up parabolically, really, for a period of time there where every single day you were accreting billions in market value? Were you surprised?
I don't say that I was surprised. I think what you're seeing now is the market is responding to what is fundamentally a very strong airplane market, aerospace market globally, and the fact that we're delivering on our commitments. We had promised production ramp up. We're now delivering on that ramp up. And you can see the profitability that's hitting the bottom line as well. So it's efficiency in our production lines, efficiency in our supply chain. So you got top line growth at the market, bottom line growth.
So it's just the investment community catching up to a certain extent?
I think it's part of it, and I think part of it is the recognition now that this really has changed from being a high cycle business in the past to a long-term sustained growth business. And I think that's changed the attitude and the perspective on the street.
What's going on, big man?
It's all about the money, boys! That's it!
Late to the party, I just don't think that's a bad thing. That I see this as a terrific example of the persistence of market leadership. And the rules to momentum investing, and we're momentum investors, is to let your winners run. You got to make sure you have the big winners to offset your smaller losses. We'd rather be selling our losers. So if you've been in Boeing, there's nothing to do. You let it run. There's been no cracks or breakdowns or signs that leadership is slowing. If you've been worried about overbought conditions, you've been out of this thing for the last 100%.
Nah, I'm just kidding you. I thought it'd be funny if you thought I was fucking retarded.
You know the main reason I like Lockheed, Raytheon, and Harris? It's because we know for a fact that all three companies are in fabulous shape. In fact, they were doing well even before Congress agreed to boost the defense budget. We know this because all three companies just reported terrific results. At the end of January, Lockheed Martin delivered a really fabulous numbers, a big top and bottom line beat, with much better than expected full-year earnings guidance. The stock had already run up going into the quarter last week, then surged up to $351 after it reported. Now it's back at $345. It's up less than $1 from where it was before the quarter. At one point today, it was up much more than it went out, but so was everything.
Defense contractor, I think it's an excellent company to own. Is that an expensive buy? Yes, that's an expensive buy. Will it come down with tensions rising in Belgium and France and other parts of Europe? No, I don't think it will come down. I think it will continue to sell at a premium. And the question you as the investor have to ask is, do I want to step up and pay a premium for this stock? That's really the question.
Uh-oh, retard alert! Retard alert, class!
Well, our investors expect us to, get a good return for the risk that we take with any program that we have. And so we're going to constantly be focused on how do we get the best value for our customer. And in that generally translates into best value for our investors.
Lockheed Martin, another one on your radar, recently won a big contract for PAC-3 missiles.
Yes, they have won several new contracts. Now, we're only on February 8th today. They have signed, just in these 8 days, just under $800 million in new contracts. Wow. And they have been consistent on signing these contracts. You ever scroll through the news feed of Lockheed Martin, you'll say, oh, they just won a $100 million contract, $200 million Navy contract. And this is a very consistent revenue driver for them. Now, these new 3 contracts go all the way out through 2021. So it's a nice long-term view for the company as well. Now, we have a couple other growth drivers for the company. Is their new F-35 fighter jets. Now, these things are a marvel of engineering. In fiscal year 2017, they delivered 66 of these jets to the U.S. government. Now, they're expected to continue to ramp up production all the way through 2020, where they're going to produce about 178 of these fighter jets and have about 750 in total operations. Now, at the same time, while they're building these jets, they're also maintaining them. So we have nice 2 areas of revenue stream. Mm-hmm. We also learned earlier this week that Congress tentatively agreed on a 2-year budget deal. This budget significantly increases defense spending, so this is a really nice other growth driver for the company over the 2 years. As we also said, their new contracts are coming in and their previous contracts. So these 3 big areas are nice, solid, long-term growth drivers for the company. Now, during their amazing earnings announcement where they beat the exact consensus earnings and revenue estimates by a large margin, management also guided in line revenues with their already high expectations for revenues, but they also increased their EPS guidance in the high-end range of the previous estimates. Now, this has caused analysts to increase their estimates as well. If we take a look at their detailed estimates page, we can see here that we have almost unanimous agreement for the next 2 quarters and the next 2 years. As you can see here, we have nice boosts for the quarters and for the annual estimates as well, especially with 2019 jumping up almost $3. So at the same time, while we have this nice long-term growth story for the company, they pay us a solid 2.32% annual dividend as well. So we have 2 companies that have really good growth expectations over the next 4 or 5 years, mm-hmm. and really nice dividends as well.
All right. Do you own either one?
I personally do not, but I hold them both in an income investor portfolio.
All right. Don't forget.
Okay, now let's try to get an answer from someone who's not a complete retard.
Buybacks reduce the number of shares outstanding and so make earnings per share look a lot better. Is that the best use of a company's capital? I'm not so sure about that. Are buybacks a reason companies should borrow to buy back their shares to lift their stock prices so executives with options can exercise them for outsized pay packages? I'm not so sure about that either. I'm not all that sure that they aren't way out of control, as a matter of fact. Buybacks are the biggest part of what we now call financial engineering. Don't forget, some buybacks are a total waste of money. I mean, a total waste of money, especially after all that money's been spent and the market takes those stocks right back down. It's poof, all gone, wasted.
It's at 89 today.
They don't tell us.
No.
And, well, we just accept
You know
that.
what? I got an idea. This is going to, if it's really that great, UPS and FedEx. Just play them.
Really?
Yeah, and XPO Logistics too.
50% on an Amazon Echo now.
Well, actually, the 80% is coming to the bottom line. So we said we're going to grow our our earnings per share by $1.20, and 80 to 85 cents is the amount that's going to fall to the bottom line, or say, again, 80% of the rest we're going to invest in the strategic initiatives so we can keep growing the business. And then the CapEx makes sense because today we get 100% deduction at time of purchase for the next 5 years. We're growing business, export.
Do well, great, fantastic. That's not the issue. The issue is sometimes they'll say like, oh, golly gee, you know, we're going to create jobs, but we don't have enough money. That's why we need the tax cuts. If we had the tax cuts, then finally we could make some money and then create more jobs. And that's what they say on TV over and over again. And they send out lackeys to do likewise, which you're going to see in a second. So, in fact, UPS CEO David Abney told the audience at a September 20th event held by the Business Roundtable, a consortium of corporate CEOs, that revamping the U.S. tax system is, quote, about growing the American economy, creating jobs, and giving us all a chance to be competitive. Now, poor guys, I mean, they only made $49.6 billion in gross profits. They can't be competitive without tax cuts. Okay, but that's...
You know, Morgan, you've really nailed it in both directions. First, we do want to make sure that we're paid for the value that we provide. Our business really ramps up during peak. That brings extra cost. We want to make sure we're compensated for that cost. But another advantage to this peak season surcharge is we are able to have very productive discussions with our large customers of how we can smooth out volume, and if it's not urgent, to avoid those key surge weeks, and to utilize weekends and to utilize weeks before and after Christmas. So dual benefit, and we feel very comfortable that it's going to come through for us.
It seems almost kind of...
Fuck your couch, nigga. Buy another one, you rich motherfucker. Fuck your couch, nigga. Fuck your couch. Darkness is.
The Walking Dead is long in the tooth, but I have some good news. There was a Wells Fargo report that says you've got like 8 things going for you. A clean portfolio, must-have content, increasing distribution, growing share of a shrinking pie, flexible balance sheet, no NFL worries at this point, and a trusted management team, that's you, and M&A optionality. So, but it has been rough sledding. You've had to navigate some tough waters recently.
Yeah, you know, that report was a flattering report. I hope a lot of it's true. We do have a great balance sheet. We have very significantly growing distribution revenue. Right. Honored theme in literature, obviously Lord of the Flies, which is a seminal book. Right. It really was essentially thematically similar. It was about what happens when there isn't social construct, what happens when there isn't social organization, right. How do people organize.
Let's talk about whether the end is near.
Are you fucking retarded? The hell's the matter with you?
Do you want me to be fucking retarded?
So from my point of view, unless there are extraordinary circumstances and a huge, legal threshold is met, I don't think it should be permissible for public companies to be able to buy their own stock back. It is plain and simple stock manipulation. And when you factor in the way in which executives like me are comped today, which is that we dilute the shareholders by giving ourselves big stock grants, and then what you do is you come in behind it and repurchase the shares to minimize the dilution again. It's just this sort of pernicious game of generating increasing amounts of comp for the people at the very top, while frankly, giving short shrift to employees and the country as a whole. And as you know, like 30 years ago, corporate CEOs earned 30 times the median wage of the wages of their workers. Now it's up to 300 to 500 times, and this practice is at the heart of it. This sort of stock-based compensation and stock manipulation.
Despite the fact that its flagship series, The Walking Dead, has seen an alarming slump in ratings over the first half of its 7th season, the AMC Network's fortune seemed to be on the rise. On Thursday, AMC Network's shares jumped 13% after the station reported Q4 earnings, which were better than Wall Street expectations. According to AMC Network CEO Josh Sapan, The Walking Dead remains the #1 show on television by a wide margin and is a powerful example of programming that we own and distribute that commands a loyal audience, attracts advertising revenue, and has significant ancillary revenues that will benefit our business for years to come. These ad sales help to bolster AMC's success, as did affiliate revenues, including licensing, which also jumped 15.6%.
You fucking retarded scumbag!
on a technical basis, one of the things that you have to look at the stock is that, it has come down quite a bit, but look how far it had rallied. The stock was up 43% in just 6 months. So it was ready to pull back anyway. And so it's just the fact that the broader market sold off so sharply because of forced selling, this stock went down quite a bit. Now, on a near-term basis, this 100-day moving average is kind of first support. But, we could see another down leg in the broad market. And if that happens, we're going to go and look at the 200-day moving average, which has been really solid support for the stock for a long time. So my kind of feeling is that they're kind of throwing the baby out with the bathwater on this situation. So if we see another downdraft in the broad market that takes it down to the 200-day moving average, that could be a real good entry point to either add to old positions or add new positions.
All right, Mark Tepper.
66 times. 66 times.
Flat right now. Home Depot, historic high once again for that. It's done that often. 10-cent beat. Revenue's better than expected. Here's what's important to me. 29% dividend hike and a $15 billion share buyback. Folks, that's almost 10% of the company they're proposing to buy back. Home Depot is what I call one of the dividend or buyback monsters that exist out there. They have aggressively been buying back shares for many, many years. In fact, they're half the amount of shares they used to have back in 2003, nearly 2.4 billion. Today, 1.2 billion. That's half. And they're going to reduce it to 1.1 in the next year or two. A number of other companies have been buyback monsters. IBM did the same thing.
Headline, Home Depot is buying $4 billion worth of stock back. Guess what? For the last 10 years, we've been buying back $4 billion worth of stock. It's when you see it as an incident, isolated, that's the correlation. Look, if Paul Krugman didn't have the Times, nobody would give a hoot about what he says. He's been wrong. He's been wrong.
Right. About the internet. That's going to fade away in 2005.
Look, he's angry.
Look, let's not make this personal.
You brought him up.
No, but it was an interesting piece today, and the reason I wanted to bring it up was because there's a question about how the tax cut is going to eventually trickle its way into the economy and what it's going to ultimately do to growth or not in this economy.
It's going to help growth. Like it or not, it's going to help growth.
I like it. I hope.
Home Depot and Lowe's too, and a lot of people, hey, we're sharing the goodies. We're sharing them. And we did it quick. And to me, people might say things like, liar! Tell us what you know, you damn liar!
Figure out, did Carol Tomei, when she upped the buyback, was that her view that things are better? Because when you do this, nothing is done idly by Home Depot.
Nothing is done idly by Home Depot. We've bought back over $65 billion of our shares, over 51% of our outstanding stock at an average price of just over $50. And we look at the increment. Are we still creating value when we buy back the shares? And we think we are.
Now, at the same time...
Hey, Janet! Why don't you pick up on your own girl? Oh, yeah, dog fight!
Wow. Okay. This really separates the men from the boys.
Why not? Now, what the banks are doing is, originally, Wall Street, you never had big blow-ups, before 1980, 75, because Wall Street was a partnership. So when they threw the dice, they were throwing the dice with their own money. Once they started becoming public, you throw the dice with public money. Then you had Bankers Trust, a few blow-ups. Now, with new financial engineering leverage, you could throw the dice with shareholder money and not yours. If you crap out, shareholders lose. If you win, you get your bonus. And now you can lever up with customers' money. So you take the shareholders' money, you lever up more with customers' money, you throw the dice, 65, 100, 120 leverage. If you succeed, estimate yachts for everybody, starting, okay? Or better. And if you lose out, you run and say there's a bailout coming. And I think Trump is actually quite pro-bank, as you can see. So it's interesting to see how it's going to turn out. No matter which way you look at it, the fundamentals don't add up to the rally.
Okay, the latest run went into overdrive in May when Wayfair reported a blowout quarter, delivering substantially higher than expected sales and a smaller than anticipated earnings loss. Buy. Even better, the company gave strong guidance for the next quarter, indicating that after 5 quarters of slowing revenue growth, its growth rate was accelerating again, back up to more than 40%. In response, the stocks rocketed up 20% single session as the short sellers got squeezed, and many of them were forced to buy in their shares in order to close out their positions.
No question that Mr. Tilson's very bearish on our business. He's openly shorted it, and then he's done everything he can to drive the stock down. The way I look at it is if you look at Mr. Tilson's shorts at Google, Netflix, Tesla, these tend to be companies that are disruptive, doing things in a non-traditional way, and the comparisons to the traditional model don't always uphold sort of where they sit. So we have a huge commitment to customer safety, product safety. We've done a great job with that, and we obviously continue doing that. But I think Mr. Tilson's really trying to find anything he can hang his coat on.
Could we address the 2 specific points that he raised, though?
Coat racks,
the one
we do sell coat racks, absolutely.
That you should test your products independently, and the second that you should have a chief compliance officer.
So these are, I think the way to think about it is, again, I don't think Mr. Tilson's really focused on consumer safety per se. I think he's focused on the stock price and trying to get it down below where he opened his short. So the way I think about it is, if you look at what we do from a safety standpoint, we do far more.
Before the call, this is you, like Price is Right. And then look at that, straight down.
Then in early August, Wayfair posted another excellent top and bottom line beat with robust guidance and bullish commentary from management on the conference call. Wayfair told us that its conversion and repeat rates have been rising. More people return to the site. These repeat users buy more stuff. Holy grail of sales. However, there's one fly in the ointment. Management told us that they're going to keep ramping up their investments in advertising while also hiring more workers. You guessed it. Wayfair's using the Amazon template, spending a fortune in order to grow in the hopes of taking over the furniture world.
Made it out of felt, there's a little bow on them.
Boy, you really are a sad little fucker, aren't you?
That falls into the category of watch this space very carefully. There are certain leading indicators. Back in 2007, I was talking about the collapse in housing prices and how this was not a good thing. This could take down the economy. And turned out I was right. And now, I've been saying, look, watch corporate bond funds. We're seeing the bubble reinflated over the last 7 years, and it's been reinflated in large part by banksterism, for lack of a better word, by companies doing mergers just to jack up their share prices, by companies doing stock buybacks. Over 90% of the low interest rate money that was borrowed by big corporations in the last 7 years, which should have been used to expand operations and hire people and build new factories, over 90% of it was used for stock buybacks so that they could inflate stock prices and increase the compensation going to the CEOs and the largest stockholders and the senior executives.
I guess you just don't realize how clueless the system really is. Yes, there's some shady shit going down, but trust me, it's fueled by stupidity. Look at yourselves. You pass yourself off as cynical people, but you still have some faith in the system, don't you?
I don't.
Well, except for Vinny. And who gives a shit?
Well, I do think this is a time when we need to be alert to buildup of either financial imbalances or to inflation building up. We don't really see those right now. I think
Although asset valuations are high by historical standards, overall vulnerabilities in the financial sector appear moderate, as the banking system is well capitalized and broad measures of leverage and credit growth remain contained. Even with the across much of the global economy, I expect that with gradual adjustments in the stance of monetary policy, the economy will continue to expand and the job market will strengthen somewhat further, supporting faster growth in wages and incomes. Although asset valuations are high by historical standards, overall vulnerabilities in the financial sector appear moderate, as the banking system is well capitalized and broad measures of leverage and credit growth remain contained.
What is the risk you see if it's not leverage?
I don't see systemic risk these days. I mean,
Then why are hedge funds?
Well, I think we always want to be concerned about financial stability. I mean, that's certainly a lesson that we've learned. And these issues loom large, especially when interest rates have been as low as they have been for as long as they have been. Right now, you're right, there's some pricing in the equity markets that look different than historical values. I think part of that's generated by the earnings that firms have been able to generate, but also because the interest rates are low. So we're certainly focused on that. Right now, I don't think that's a significant risk, but I'm certainly taking that into account. And again, that's another factor that feeds into my view that a gradual reduction in accommodations is appropriate for where the economy is now.
My real passion is my hobby.
Really? What's that?
I work with retards.
We're just at the end of the deleveraging process. Now, maybe this administration, I do believe this administration is going to allow for more leverage to come back into the system, but we have so far to go for that to be a systemic problem that it's not something I'm particularly worried about.
I'd say there's mathematically zero chance of that happening.
You think that right now there are few signs of excess of the kind that usually precede an economic downturn, and this is pretty significant or topical because increasingly more and more people have been talking about 2019 next year maybe being a year where we see recession. But right now you don't see that happening. You don't see the signs.
I fucked up.
Recovery that's going on where GDP in Europe is stronger, in China and Japan and in the U.S. And so that's kind of story number one. Story number two is the signs that this rally or this recovery is over anytime soon are just not there. There's no signal that you're going to see a recession soon, which means this can go on for longer, and that's why this thing is as powerful and as global as it is.
You don't buy the argument.
Hate this place a geographical oddity. 2 weeks from everywhere.
I think that's right, and people are so prepared to believe that what happened most recently is going to happen in the future. Just because that happened in 2008, that was a once-in-9-decade experience. So there's not that leverage in the system. People worry about market corrections. Market corrections happen all the time. We had a 16% market correction from the end of middle of 2015 into 2016. So you might see some volatility pick up in markets, but to think that we're going to have a systemic collapse and a financial crisis like we had in 2008 is the height of hyperbole, in my opinion.
We were robbed. Do you think so?
Given permission from 12 to 1 to nearly 50 to 1. We know that they engaged in all sorts of speculative activity where they didn't understand the risks. Their models were just wildly optimistic. They were so busy counting profits and bonuses that they didn't pay attention to the bottom line.
He'll enjoy Oklahoma's wide open spaces. He loves to run and run and run.
Well, it means that there's less shares outstanding. Companies have reduced the share count by over $3 trillion since the end of 2011. And central banks have added $16 trillion to the balance sheets, to their balance sheets, meaning they've created $16 trillion
with which to buy financial assets. So we've seen globally, we've seen the market cap of all stocks go from 30 trillion to 80 trillion, all on very little increase in the economy.
Well, you know what, Charles? Now, it's an interesting point because, you know, whether you like this analogy or not, you wrote me yesterday that something about this reminds you of housing prices prior to the credit crisis. Please explain.
Well, prior to 2007, everybody knew, particularly in California, that the price of single-family homes could never go down. It might not go up for a year or two, but it was always going up, and therefore you could pay more than the house is worth and do some crazy leverage stuff because higher prices will bail you out. So since 2009, the U.S. Global stock markets are up trillions and trillions of dollars, and with interest rates at zero, who knows what kind of leveraged games have been happening. And when the tide goes out, meaning when central banks stop printing and prices go down, there'll be incredible garbage coming up from when the tide recedes. When the level of the ocean, you'll see, oh, it's going to make 2009 and all those problems seem minor in comparison.
All right.
Come on, share your